Hey everyone, and welcome. Today, we're not just going to talk about investing in general. We are going to get specific and talk about building your personal investment blueprint. Seriously, think of it like drawing up the architectural plans for your financial future, making sure everything is built on a rock-solid foundation. So let's get to it and start laying that first brick. So before we even think about a stock or a bond, the very first question we have to ask is about you. What makes you tick? What is your unique financial DNA? Because trust me, understanding your own personality, your goals, and where you stand financially right now, that is the absolute non-negotiable starting point for any strategy that's actually going to work. All right, so here's the game plan. First, we're going to decode your investor DNA. Then we'll dive into the different strategies you can choose from. After that, we'll tackle the big one, the active versus passive debate. Then we'll look at some real-world portfolio blueprints you can actually use, and we'll wrap it all up with a super important look at the common traps you need to avoid. Let's get building. Okay, first up, the foundation. You know, any good blueprint has to start here. And in the world of investing, that foundation is a really deep understanding of yourself. Without this, even the most brilliant, sophisticated strategy in the world can just crumble under pressure. Let's kick things off with risk tolerance. This is all about your gut, right? Your psychological comfort level. How would you feel if you woke up tomorrow and your portfolio was down 30%? Yeah, your honest gut reaction to that question is probably the best indicator of your risk tolerance. It's totally personal. Now, this is where it gets really interesting because risk capacity is totally different from tolerance. Capacity isn't about your feelings. It's about the cold, hard numbers. It's the math, the objective reality of what your finances can actually handle. You see, a young investor with decades to go until retirement has a way higher risk capacity than someone who's about to retire, no matter how they feel about risk. And you know, we absolutely have to talk about one of the most powerful biases that messes with pretty much every single investor, loss aversion. This is that horrible, gut-wrenching feeling you get when you lose money. And it's such a powerful force that it can make us do really irrational things, like panic selling at the absolute bottom, or maybe worse, holding on to a losing stock for way, way too long. Yeah, and this quote just nails it. It quantifies that feeling perfectly. I mean, think about it. The sting of losing $100 is roughly twice as painful as the joy you'd get from finding $100. Just understanding that this weird psychological quirk exists is so key to not letting your emotions blow up your carefully laid plans. All right, so once you've got a handle on your own DNA, it's time to pick an architectural style for your portfolio. Think of these strategies as different philosophies, different ways to build. And look, there's no single right way to do it, but there is definitely a right way for you. Really, the two big philosophies here are growth and value. A growth investor is kind of like a hunter, always searching for the next big thing, those super innovative companies that are just plowing everything they earn back into expanding like crazy. A value investor, on the other hand, is more of a bargain shopper. They're meticulously looking for solid, established companies that the market has, for whatever reason, unfairly beaten down. So, the appeal of growth investing. It's pretty obvious, right? You're swinging for the fences, aiming for those higher potential returns by getting in on the ground floor of innovation. This can also add some powerful diversification to a portfolio that's full of more traditional stocks, and it can unlock the incredible, almost magical power of long-term compounding. But don't count out value investing. It has its own set of serious advantages. By doing deep fundamental analysis to find those bargains, you often end up with a much stronger risk-to-reward setup. And hey, as a nice little bonus, these more mature companies are usually the ones that are more likely to pay you a steady stream of dividends along the way. Okay, so you've picked your philosophy, growth or value. Great. Now, how do you actually do it? This brings us to probably the biggest debate in investing, active versus passive. The core question is this: are you trying to beat the market, or are you just trying to be the market? All right, let's just look at the hard data for a second. This chart shows how funds managed by pros, the active ones, did against their simple passive benchmarks over a whole decade. If you see orange, that means passive investing won. If you see green, active won. Now, just take a quick look. What's the first thing that jumps out at you, especially in that top row for the US market? Yeah, it's a sea of orange. And this number right here, this is the knockout punch. Over that entire 10-year period, A mind-boggling 87.42% of all large-cap active funds in the US failed to beat their benchmark, the S&P 500. Just let that sink in for a second. Nearly 9 out of 10 professionals whose entire job is to beat the market failed. So what's the big takeaway from all this? Well, for most of us, especially in really efficient markets like the US, a passive approach has just historically been the better bet. By simply buying a low-cost fund that tracks the whole market, you get instant diversification and you very often end up with better returns. Why? Because you're not paying crazy high fees to a manager who is, statistically speaking, probably going to underperform anyway. Okay, let's start putting all these pieces together. We've talked about your DNA, we've talked about strategy, we've talked about how to execute it. Now let's go from all this theory to actual practice and look at a few popular portfolio blueprints that you can use as a jumping-off point. And first up is the absolute classic, the 60-40 portfolio. It's a balanced approach that has really stood the test of time. That 60% you have in stocks is your engine for growth, right? And the other 40% in bonds, that's your stabilizer. It provides some income and, more importantly, it helps smooth out the ride when the stock market gets all choppy. Now, for a totally different approach, you've got the permanent portfolio. This thing is designed to be stable no matter what the economy is doing, whether we're in a boom, a recession, seeing high inflation, or even deflation. The idea is that by splitting your money equally between stocks, bonds, gold, and cash, at least one part of your portfolio should be doing well no matter what's happening in the world. And look, these are just a few ideas. There are tons of other blueprints out there. You could build a portfolio focused entirely on generating steady income from dividends. You could stick with the big, stable blue chip companies for maximum stability. Or you could build something like an all-weather portfolio for consistency. The real key here is to find a structure that actually lines up with your DNA and your goals. All right, our blueprint is almost finished. But before any construction starts, a good architect does one last check. A final inspection to look for any hidden problems. For us, that means we need to identify the common traps that can completely sabotage even the best laid investment plans. So here are 3 huge diversification traps you've got to watch out for. First, don't over-diversify. Spreading your money so thin that you just dilute your own returns is a classic mistake. Second, make sure your assets aren't all correlated. I mean, owning 5 different tech funds isn't diversification, that's just concentration. And finally, you have to remember to rebalance. If you don't, your winners can grow so big that they accidentally crank up the overall risk in your portfolio without you even realizing it. And that really brings us to the final and maybe most important question. Just take a second and think about your own approach. Is it truly built on a solid foundation of self-awareness and a clear, intentional strategy? Or is it maybe more of a house of cards, just waiting for the first strong market win to come along? I promise you, having that well-thought-out blueprint makes all the difference in the world.